We are live. Welcome to the Portfolio Builder Update video. Today's November 9th. We've got a nice live crowd. I'll do a shout out to the live crowd. Let's hop through some headlines really quick. The high risk, high return portfolio is now up 343% year to date, outperforming the S&P 500 13 times. Quick review of our strategies. Portfolio Builder has 4 portfolios, one of which you get on your free trial, which is the riskiest strategy. All strategies follow the exact same hedging devices, the same growth to value devices to try to give you a nice smooth return over time. The way we increase or decrease risk is by going after bigger or smaller markets. The high risk, high return portfolio is currently up 6% in November. It's a big bet on Ethereum, but it's hedging you against inflation with 2 really nice plays, oil and gas, plus rare earth metals. It's got a downside hedge with UVXY currently. Safe Alpha portfolios up 6% in November. This is the Buffett Portfolio. It's very similar to Berkshire Hathaway. Not exactly. He's got a big bank and a big Apple position. We're similar, but we are big in the NASDAQ and then big in oil and gas. We'll talk about the comparison of those two. That portfolio has done extremely well this year, with the US just dominating and hogging all the gains compared to world stocks. Safe Growth Pro is the DALIO global strategy. We diversify capital into Asia, Europe, and the US. And it's my favorite pick for the next decade, although it's been having a hard time keeping up with those US stocks. Want a hybrid of all 3? Look at our Bootcamp core portfolio. We're going to give you big tech. We're going to give you some Chinese tech exposure. We're going to give you various inflationary hedges, some of which are not in the Safe Growth Pro or the Safe Alpha. And we're going to also give you a large crypto position. Okay, so those are the 3 programs we offer. And again, exact same methodology, exact same hedging strategies. We're just going to go after bigger or larger market caps to control volatility. Now, what's dead ahead is stock buyback seasonality, market melt up. We've been saying this since the sell-off in September, and it's played off really well. What likely comes next is trillions in new stimulus, which may soon pass. The Virginia governor and New Jersey, I believe it was the president's Senate seat, Democratic defeats lit a fire under their ass. Okay, so we had Pelosi promising, well, actually we had Jayapal promising that the progressives would not let the infrastructure deal through without the social spending bill. And no joke, just days after those defeats, that all changed, which we predicted would again pressure the Democrats to get this through. Now, what's also happening is Biden and Kamala have record low polling right now. I think Kamala's in the 20% approval rating. Biden's hovering over 40%. So what they are realizing is this is probably the last chance to pass spending before the midterms. So I am anticipating that they're going to come together and put some spending through because it's the last chance. Now the CBO is rating the Build Back Better plan, and they're saying we might have an idea by the 15th. So we'll see if this gets pushed through and gives the market another big melt up, which I think could last until about March. So currently I'm issuing a buy, red hot trade alert. Now remember, markets love to climb a wall of worry. I know everyone's worried. Let's talk about what would change my mind and make me think we're actually going to have a significant crash. Now, this is outside of watching the politics play out. We know these guys like to play a pretty close hand and pass budgets at the very, very last second. So they will do a lot of bluffing until the very, very last chance. And we got to remember, December 3rd, debt ceiling, probably we got to get some deals going through by November 20th. But okay, so yeah, so we actually had some funny comments in the chat. I was speaking to Morris yesterday, said he dumped some Tesla this morning when it was up. We had a fellow named Joe wanted to sell his Tesla at 600 and invest in our private equity deal. And he had a huge Tesla position. I said, hold on a second. I actually think the Nasdaq's going a lot higher. And it just went absurdly higher. Friday, I was telling him, you know what? I don't know why, but I think we're near a top. And then funny enough, you got Elon Musk wanting to piss off Janet Yellen and the Democrats about this idea of taxing the billionaires on unrealized gains. So he announces a Twitter poll to dump 10% of his position. And this is days after his brother had sold $100 million worth of Tesla. So you never know what sort of wild card's going to be thrown at you. Tesla's now 5% of the NASDAQ and I think 2% of the S&P 500. I'm looking at today's market action, and I think the only reason we have volatility is the 10.9% drop in Tesla, which started today and began yesterday. Now, not a lot of a sell-off yesterday. Today, it's definitely catching some eyes. In terms of Tesla creating problems in the market, if it goes below 1,000, I will be definitely interested. If it goes below 800, I'll probably get scared. Okay, so these are two levels to keep a close eye on because Tesla is not just a big factor in the QQQ and the SPY, it's also a huge position in ARK funds. Just about any new age ETF you can come up with has a huge Tesla fund, big positions in central banks. It's a very important company. And again, it's on the top of my watch list since it went above 1,000. Okay, the next stock that I have at the top of my watch list is Exxon. So we got the ultimate growth stock, Tesla, and then we have the ultimate value stock, Exxon. So I'm going to be more concerned about deflation if we see Exxon falling. If we see Tesla falling, that's really a signal that we're getting a growth to value rotation in general. So I'm much more worried about the energy companies dumping compared to the tech stocks. In fact, if we remember our big macro view over the next several years, it's that growth will rotate into value. So Tesla has definitely got my eyes open, watching it carefully. I think it's going to stabilize here for the time being. We're not sure if Elon's even begun to sell, when he's going to sell, how fast he's going to sell. But it does look like he will because he has a huge tax obligation from the options he was awarded based on growing the value of Tesla. Okay, meanwhile, the dollar is another main indicator I'm watching, DXY. If we had the energy sector dumping, the price of oil dumping, the dollar rising, I would be much more interested in this volatility today. But instead, we got bond yields falling, TLT, getting short squeezed. Amazing move on the TLT based on what I see coming down the pipeline. But again, DXY is at 94. Our line in the sand is to break above 94.50. Okay, now what does that mean? If the dollar is going up in value compared to the euro and foreign currencies, typically means problems in the financial system, dollar liquidity issues. And again, it's not necessarily the cause of problems, it's just the symptom that can tell us there's problems in the economy. And I relate it to high blood pressure. The high blood pressure is not causing the high blood pressure, but if we know there is high blood pressure, we can understand there's a risk of a heart attack. And so that's the way I look at the dollar. But again, we're not anywhere near 94.50. In fact, it's down on the day. Okay, my main problem for markets over the next 3 years are going to be interest rates rising. The government needs to borrow a ton of money, and the interest rate's too low relative to inflation. So this is something I believe is going to be a big problem and constantly cause central banks to have to fight against this by doing quantitative easing, which we've now announced the opposite. We're going to begin tapering. So TLT below 140 would be a huge problem for markets. It's all the way up at 151.31 and getting short squeezed currently. We'll talk more about that when we look at bond yields and the yield curve. Okay, the best indicator I believe we have of a crash incoming, which predicted the March crash of 2020 all the way back in January and February and all the way through March, is spot oil. Brent oil is what I'm looking at. Below 75 is a huge problem. Today, it's marching up 1.1% at 83.98. Okay, what else can we look at? The real estate sector in China continues to tank. Goldman Sachs just said they're buying the dip on these bonds currently, that the Chinese are not going to be able to have a GDP crash, and that they're likely to bail out the housing sector any second now. So anyways, we're looking at a few tickers to spot out problems from China. Their currency, USD, CNY, the dollar against the yuan. My line in the sand is 6.6. This puppy just can't get weak. It's continuing to stay strong at 6.39. So again, the bigger number would be the weaker yuan. So these are lines in the sand to set off alarm bells for volatility, none of which are ringing a bell currently. What about the price of gold? Gold is flat, no signs of problems there. Emerging markets not tanking, so we've got EEM. If it were to go below 48, I'd get worried. It's at 51.16. MCHI is a Chinese specific ETF. If it were to go below 65 to 60, we've got problems ahead, but it's currently at 68. So we're really just not seeing anything to become ultra alarmed about, other than the debt ceiling crisis coming in at December 3rd. But again, based on the politics, I think they're going to pass a deal. Okay, now once again, at the end of this video, after covering charts, data, and news, we will reveal the exact trading formulas of each strategy. So you'll know exactly how to copycat our portfolios and get the exact same returns. So again, our prediction since September was a melt up in stocks, crypto, commodities, and that this will last at least until mid-November, give us good news on the budget, and pass it, and this likely can push us all the way into 2022 Q1. So we've not changed our positioning, and that's our analysis on the volatility today. It's all Tesla. So if Biden's Build Back, they've got so many names for this package. We'll just call it the Build Back Better plan. If it's passed, I believe we can see markets melt up all the way through March. After that, we're going to have a huge fiscal cliff and need to see massive jobs coming online. Remember, the OSHA mandates hit January, so this is going to slow down progress in jobs. Now, failure to pass the budget will result in another debt ceiling crisis. They need to use reconciliation to increase the debt ceiling and pass these budgets in one bill. Otherwise, they are trapped. So unless McConnell throws them another bone, things are going to get very interesting if we don't see progress from Manchin and Sinema giving a thumbs up to the Build Back Better bill. So we're likely to see volatility in markets by November 20th if no progress is made. And that's what I'm paying the most attention to outside of looking at different indicators. So now may be the best time ever to follow our high risk, high return strategy. Goldman Sachs says they see $140 billion of non-fundamental flows coming in daily, buying these indexes. Now, if we crash, we don't need to freak out. We're along the UVXY, and I'm getting ready to increase your position probably by 100 to 200%. We've let it go very low, and it's been very profitable to ignore volatility. But we're approaching that time where it makes sense to be safe, lock in all these gains we've racked up, and even get ready to make even more money if the right series of bad events comes true. Now, in the March crash, you made 1,000% return in just under 4 weeks with UVXY, with a 30% sell-off in a month. Get this, the market can now fall 40% and still be above the pre-crash March 2020 levels. So the February high of 2020 is 40% below where we're at today. Let that sink in. Okay, that extra, just if we fell to the February high, not even talking about that March low, we could be looking at a 2,000% return if you get the right panic, which I think would be essentially a debt ceiling crisis that gets dragged out too long into December. Now, again, I don't think that's likely to happen, but if it were, that is certainly an event that could be playing out for us. And we're going to be ready for it the closer we get to these dates. If I had to watch one single indicator to predict deflation or a stock crash, it's going to be a sudden crash in oil prices. Okay, everything else I believe is a bit of noise. Now, my core prediction remains that we have a slow motion multi-year rotation out of growth into value. And here's a look at these patterns in energy companies. Okay, so 2000 to 2008, we had, 2002 to 2008, the pattern was to increase deficits and suppress bond yields. They actually tried to balance the budget in 2001, and you got a 2-year stock crash. So the government learned not to do that anymore. But you got a 5-year melt up in the energy sector as interest rates rose until it eventually crashed the housing sector. Now, the housing sector started to sell off years before the big financial crisis. So you got to be patient with a lot of these predictions. After that, they doubled the deficit spending. So we went from a $500 billion deficit spending from 2002 to 2008, go crash the global economy, bail out the banks by trillions of dollars, and then we go to a $1 trillion a year per year deficit clip. We did yield curve control with quantitative easing, and boy, oh boy, you get that inflation, get those rising interest rates, and you get another 5-year, in fact, this time more like a 6-year cycle in energy companies. Now, when Mr. Trump came in, they immediately started talking about quantitative tightening, raising interest rates, and it led to all sorts of volatility, as you know. We'll take a better look at some of the data over that period. But then we go do a global lockdown, and we didn't just double the deficit. So in the last 2 cycles, the trend was to go from a $500 billion deficit to a $1 trillion deficit. This cycle, we've jumped to $3 trillion. Now, I don't think they're going to be able to pull off a $3 trillion deficit next year. And that's what we call the fiscal cliff. And that's why it's so important they keep the spending as high as possible at the government level if they want to avoid a stock crash. Either that or you get massive jobs growth. And we really need to be getting 750 to 1 million jobs per month quickly to get back to where we were. We'll take a look at that. Either way, I think the energy super cycle is just getting started, and we're remaining very bullish in that with NRGU. Now, what should we expect when the stimulus passes? Test 1, 2, 3. Are you guys getting audio? Okay, it looks like we are getting audio. Okay, we are live and the sound is good. Okay, good. So what should we expect when the stimulus passes? Well, it's going to benefit foreign continents because we import all our goods here. So that's really the trend. So I'm expecting in the pro strategy to see outperformance in EDC, which is emerging markets times 3, and EFO, which is EFA times 2 or Europe times 2, to outperform the US markets, which have been dominating for well over a decade now. So it's a big call. We'll see if it plays out. Last time we passed stimulus was December and February for about $3 trillion in total. You can see emerging markets outperform US markets by 50%, and European markets outperform US by 30%. I'm also going to anticipate that as soon as the debt ceiling is lifted, we're going to see a lot of debt being issued, inflation continuing to run hot, and interest rates being really below inflation. It's going to make those rates rise and continue the growth to value rotation. And here's what that looks like in a chart. Last January, February, at first, the NASDAQ and energy sector went up together. But once those interest rates really got pushed higher, the bears were pounding away at those bonds. You can see the yellow line that represents yields rising on bonds. Well, what happened? The energy sector got the wind knocked out of it, and the energy sector went up. And we also saw crypto take a hit in that period. So we call it long duration assets. And essentially the tickers to watch out for, if you see the TLT fall too far, too quickly, it's really the rate of change that upsets these markets. We'll expect the QQQ and assets like cryptocurrencies to have problems, and for the benefactor to be banks and energy companies. So XLE and then FAS. Now, what happened? We go and pass all this spending, blow it all, recover nothing, and then have the sickness sweep its way through Asia. And boy, oh boy, those yields fell right back down. Energy flatlined, had a sell-off, and the NASDAQ went right back up. So we'll look at where that chart looks like today in a moment. Okay, so very good. If you are watching this on YouTube as an advertisement, you're not going to get the trading formula to follow our exact strategies. It's going to be cut off. You need to call Dean at 505-322-7515 to upgrade your free trial and gain access to our membership area. And here's what's cool about the membership area. Once you log in, you can go to, let's say, our high risk, high return strategy and say, you know what, I want to invest $50,000. Hit calculate. It's going to take the total to invest, divide it by the cost of one unit, and then multiply it by the ratio of shares. It's this ratio of shares that dictates exactly how to invest your capital. And it means every member has the exact same ratio of shares. So we all get the exact same return over similar periods of time. Okay, so you will get access to all 4 strategies when you upgrade. In general, I like to see my clients put the bulk of their money either in the Ray Dalio Global Safe Growth Pro or into at least a US-centric position with the Safe Alpha Warren Buffett strategy. Now, if you want to be a little more aggressive, then I would combine the hybrid of all 3, the Bootcamp core plus the high risk. Okay, so that's the different combinations. And when you do upgrade, you get a call with me. I can give you some tips on how to figure out the best asset allocation for you. Okay, so let's go ahead and jump into some content here. Okay, Dennis says, what's the name of the software to this trading strategy and what does it cost? Dennis, give Dean a call. He could walk you through everything and get you upgraded. This is turnkey software that only Portfolio Builder has the rights to. So we did program this all in-house. Okay, quick live shout out. We have 75 live. I'm gonna, Orlando has his hand raised. Hey, Orlando, how's it going, my friend? But live, we have Orlando, Andrew, Ashhawk, Barry, Bernadette, Bill, Bob, Chang, Clint, David, Rabin, Dennis, Don, Dwayne, E, Cubio, Eddie, Edgar, Elizabeth, Murray, Aaron, Irvin, Gary Barber, George Plumas, Hank Stram, Herman Blash, Jam, James Goodman, Jan, Jeff Olson, Jenny, Jim, Jody, John Johnson, Joseph, Kathy, Kevin, Kimberlyn, Nell, Larry, Martin Brooker, Marty, Michael, Mike, Mims, Morris, Murray, Buy Downtown 30, Neil Hathaway, Parag, Pat, Peter, Rick, Rob, Robert, Ron, Sabri, Sean, Tom Sharp, Stephen, Tariq, Terry, Tom, Victor, Walter, Wayne, Wendy, and Whit. So way to go, everybody. Thanks for joining us live. I'll go ahead and do open mic at the end, okay? So if you want to talk out loud, I was just on the phone with Orlando, who's super happy. He tripled his money in a year. We've got Jeff Olson, who's up over doubles after getting hit hard in the March crash of last year. We got a lot of great success stories. So, all right, guys, let's go through the data. So a lot of people like to look at what I call lines in the sand or voodoo magic with technical analysis. I'm pretty boring. I look at things like yield curves, interest rates. And so we'll look at some lines in the sand in a minute, but let's start off analyzing the hedging strategies. So what's our biggest fear? Our biggest fear is the Fed is going to have to hike interest rates. Now, why would they do that? Either because the inflation is becoming problematic for the economy, and check mark, that's already occurring, or B, we've got a strong labor recovery. That's not here yet, and why I believe they're being as slow as possible to taper and raise interest rates. Now, this chart is going to predict when the Fed's going to hike rates based on where short-term interest rates are headed. And so the spoiler alert here is that we've suddenly seen a massive increase in probabilities of interest rates getting hiked next July. Okay, so I was actually thinking this wouldn't happen till the end of the year or after midterms, but markets are starting to predict this even sooner. And the big trend that kicked this all off was the Australian bank took away yield curve control on the front end of their bond market, and the 2-year interest rate went up 500%. And I'm gonna go ahead and skip to the US rate so you can see what that looks like in the US. So our interest rate on the 2-year bond has gone straight up. Okay, so it's gone up 250%. It's dropped down today to 175%. Okay, so if this interest rate goes up, that's going to signal the Fed needs to hike rates. And then simultaneously, we're seeing the long end go down. So we'll talk about that and more. But yeah, this is starting to tell us that we have a probability of going one rate hike by July. And one rate hike may not piss off the market, but you give it 2 or 3, and I believe you will. If we go all the way out to February after the midterms, which is when I think the probability of rate hikes becomes much more likely due to politics, we can see the probability is growing. Now, the darker the line is, the more recent the data, and the lighter the line, the further back. So if we go to this July, you can see the probability has been rising. Okay, it pulled back a little bit today with that long end yield going down. But this is going to be what gets us out of growth stocks and out of cryptocurrencies specifically, is predicting when rate hikes are going to come. Okay, so if you look at the crash in 2018 on Bitcoin, this is exactly when we began to do quantitative tightening and raise interest rates. And so first Bitcoin dunked about, I think it was 90%, little less, between 80 and 90%, 20,000 down to, I think as low as 2,500, just phenomenal. Then emerging markets tanked, then European markets tanked, and then finally in Q4 we got the Christmas massacre. So the 10-year hit 3% yield, and the entire US stock market sold off for 3 months. And then they did what? They reversed course, and it was a great buy the dip opportunity. That's exactly what I'm anticipating is going to happen once they start to hike interest rates. So we'll talk about that, and that's really what you need to be an expert at, is when is the Fed going to hike interest rates to call a top. All right, let's look at the yield curve. In this chart, we have March in green, July in black, and blue in current. In March, we saw the interest rate on the 30-year bond approach 2.5. It hit 2.4. Okay, so that's what we're going to be. And let's go ahead and pull one more back so we can just see how the rate of change here. So you can see we went from January 1.9 on the 30-year, and then 3 months later, that interest rate skyrocketed to 2.4. And that's exactly what caused the rotation out of tech, out of crypto, and into energy. So if you're wondering why we got that NRGU, it's not just a greedy play. It's critical to hedge our growth plays. It is really an important part of any portfolio that you can put together right now. Okay, so so what do we make of the current yield curve? It's flattening. Okay, so we've got we can see this huge jump in the front end. And then we see the long end is starting to pull back. So that's not really what we want to see. If we thought we had a healthy future ahead, this should be a nice ramp, like a skateboard ramp at a skateboard park. So I'll have to get you guys some pictures of that. What's happening right now is telling us that we've got too much inflation. The Fed's going to have to hike interest rates to curb it down, and it's going to cause a stock crash. That's what I make of what we're seeing in this data. Okay, let's now look at where the market's hedging. This is the VIX, the Volatility Index Futures Term Structure. We're playing UVXY, which is basically playing the front month against the second month on the futures curve. And so for us to make money, we want basically the cost of put options to go up relative to the cost of call options. And so if the market's falling, that's exactly what happens. Now in this picture, the way to think about it is to focus on where the dots go up the most. And so the biggest leap is now from December to January. Previously, we'd seen it from November to December. So what's critical about these two periods? Well, we got to pass the budget. If we don't pass the budget, we have a debt ceiling crisis. This whole thing falls apart very quickly if the debt ceiling is not raised. I think the probability of a debt ceiling crisis occurring after Virginia upset of the governor election is relatively low. I do think the pressure is to pass whatever they can and avoid any more political carnage. So I think they will be much more likely than they were just a few weeks ago to pass these budgets. So we're carefully watching that. Next thing is the central bankers. Jerome Powell was very interesting about how he talked about tapering. He said we will reduce the quantitative easing by 15 billion in November and 15 billion in December, and then we will reevaluate into January. So there's your wild card. They could stop tapering. They could continue the 15 billion, or they could revert into quantitative easing. So the December FOMC meeting could be pretty important, and most likely it'll be looking at stock volatility, which is not supposed to be what they're watching, and then it's going to look at labor markets. So labor recovery. We've got the CPI coming out tomorrow, which I think is going to be hot and above the last print of 4. But I think right now labor recovery is the most important factor, as well as passing the budget and then stock volatility. So you can see the market's worried from November to December. But if the budget passes and the tapering remains at this slow pace, I'm expecting a melt up into Q1 of 2022. Now, another way to predict that interest rates are going to rise and become a problem for markets is to watch reverse repo. What is reverse repo? So reverse repo is when banks say, you know what, I cannot find enough short-term debt instruments in the market to service deposits on my bank. So I'm going to go to the Fed and borrow up all the bond products that they've bought through quantitative easing. So in other words, if we see this falling below $1 trillion and then going down towards 750 billion, tells us the interest rates are rising in the open market and starting to attract the bid of the banks. And so that's going to be our easy way to predict when there's a risk of interest rates rising. This has been really trading between a 1.6 and 1.3 trillion dollar range for weeks now, and I don't anticipate it falling anytime soon, not until we have passed some budgets and are issuing a lot of debt into the market. All right, so let's take a look. So here's your NRGU. You can see how volatile it's been. Now, this is going much, much higher in my opinion, at least 2 to 3 times higher. So we'll take a look at that. I know that seems pretty unbelievable, but just since November, NRGU is up 700%. Now let's zoom in on it and let's look at what's been happening with interest rates. So since June, we can see, and this is why I underperformed this summer. I thought that we were going to have the oil spike and the reflation play a little sooner than it actually played out. But you can see the gray line are interest rates. If it's going down, interest rates are falling. What do you know? NRGU goes down and the NASDAQ goes up. And then what do we get? This is actually pretty interesting. We get interest rates going up and NRGU skyrockets higher and then stabilizes. And then we get this pullback in rates and you get the NASDAQ higher. So what comes next? Well, let's zoom in on, again, the last time we were spending money in the government. So we did pass the infrastructure deal, but that's very slow spending. The one that's going to make more of an impact is going to be the Build Back Better plan. Let me get a good view of this. Okay, and here's where the action hits. So we get these interest rates going up, 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 up. You get the NASDAQ to sell off, and you get NRGU going parabolic. So that is what I believe will happen as soon as we pass the budget. The interest rates go up, NASDAQ comes down, banks and energy goes up. Okay, because we're going to basically remove the debt ceiling. Janet Yellen is going to start issuing tons of bonds. Inflation expectations are going to rise, and bond yields rise, and that forces that rotation of money. Now, what's going to happen if we do the opposite? Well, I'd actually expect stocks to sell off as a whole and for treasury yields to go far lower, because we have this limited supply of treasuries. The banks are fighting over them as it stands, and now we're not going to be able to issue anymore. So we'll actually have a limited supply of treasuries if we hit that debt ceiling. So that's why this little battle on the budget is so important. All right, let's look at some more indicators. We got the Russell 2000 broke above a channel it's been trading in for the entire year. Very bullish, give it some more stimulus, and I believe it's going significantly higher. Here's a look at it zoned out. You can see it was in this channel from February and finally broke out of it. Now, if we look at emerging markets, holding its ground, this is going to be extremely bullish when the dollar falls, which will happen when the stimulus passes. And so actually getting ready in the pro to add exposure to EEM and to pay for it by taking profits off of the S&P 500. This is also Ray Dalio's favorite play for the decade, is betting on Asia. All right, Europe is heavy in banks and really set for interest rates to rise. Been acting very strong. Again, as soon as we pass the stimulus, expect this to break into new highs. We have exposure to this in pro. Bitcoin's actually been dominating right now a little bit. Let's see if we can get that in a chart. We like both. I think it's smart to be long Bitcoin and Ethereum in equal weights. That's how I have it structured for Rebel dividends. If I'm just going for a home run hit, I like Ethereum over Bitcoin. Now, if you are going to play Ethereum, I think it's important that you understand that its transactions costs are outrageous. Okay, and this is causing people to not want to sell. Um, and then you got to realize there's competitors that are trading for pennies. Okay, so while it costs you 10, 20, even $100, depending on network congestion for Ethereum, you can go trade with Solana, Polkadot, Cardano, Binance Smart Chain for pennies. So what's the real purpose here? To lock people into positions and make it inefficient to make transactions, or not. And so obviously that's a problem that Ethereum must fix, and they are switching to proof of stake to keep up with their peers in Solana, Polkadot, Cardano. So we're hedged against that with the Rebel Dividends private equity offering. We don't have that exposure in our portfolio builder membership. So I'm watching it like a hawk and looking at ways to protect us. But we're only trading stocks that give us exposure to crypto at Portfolio Builder. And that's because the complexity of buying real cryptocurrencies is often too risky for most investors. So hopefully Grayscale Trust will add in Solana, Cardano, Polkadot in the near term future. All right, is gold and silver gonna do anything? We actually did really well with gold and silver last year. And luckily got most of our position out near the high. Since then, it's been a real dud. So what we've seen are the commodities that are useful for the economy going up. So first we saw lumber go outrageous for housing. Then we saw copper take off. Then we saw oil take off. We saw natural gas take off. Now we're seeing the chemicals for fertilizer, ammonia, record pace. And so this has all been a reflation play in general. And I think we're going to see gold and silver really shine if we end up in a period of stagflation, probably Q2, Q3 of next year. So maybe it starts building up for that prediction. It's all going to be about labor recovery, and so that's yet to be seen. Will Biden's policies aggressively grow the labor force? If so, gold and silver probably have some problems ahead. But if we end up in some serious stagflation, these might finally play out. So in safe alpha, we've got a gold play, and in pro, we have a silver play. I believe we're about 8% long UGL for safe alpha and about 4% long AGQ for silver. We'll look at that exact percentage in a little bit. Okay, now if we're going to crash, there's really only three products I like. It's TMF, that's treasuries. Wouldn't buy them today. Look at that short squeeze. So just a week ago, everybody's talking about how there's a record short position in the US Treasury market. And boy, oh boy, the jobs data came out, and we'll talk about it. It was relatively good at 500,000 jobs. The problem was the labor force participation rate didn't budge higher. And I think it really needs to start moving up because to get back to where we had the jobs in February, we need the labor force participation to dramatically increase. And then where you look at where the labor should be based on its growth pattern, it needs to go even higher. So we're we're millions of jobs below where we should have been had we not locked down the country in March. So 5 million just to get back to where we were. And then you look at the trend growth, and it's probably more like 9 million. So the bond market's sniffing out that we need a lot of stimulus, otherwise this puppy is crashing. So there you go. You got TMF jumping about, what is that, 20% just since the 7th of October. Quite a move, very impressive. The dollar is just staying flat. It's at a critical level. I believe once the stimulus passes, it's going much lower, and we're positioned for that. And then we've got UVXY, actually went up with stocks by about 10% since the 3rd, due to record amounts of option buying, primarily call option buying. I think it's like 10 times the normal average of call option buying. And that makes the cost of all options go up, including put options. So that actually made UVXY go up. Sometimes that can be a warning sign. So those are the 3 products we want to build up on if we think we're going to crash. Treasuries with TMF, that's TLT times 3. EUO, that's betting on the dollar against the euro. And then UVXY, think of that as out of the money put options on the S&P 500 that automatically roll over every week. It decays at least 2% a week. So it's a product that's not popular, but it can really save your butt when the right outcome occurs. All right, some bonus plays we have in the Bootcamp core primarily. So MJ, boy, that one's been the biggest dud. Finally got a big bid yesterday. It was in the top charts, top 3. Jumped 7% yesterday. So we like that play, and I'm very happy to see it getting a bid. News headline of Republicans trying to make it legalized. The fundamentals for the space have been getting better and better. But again, it's a progressive Democrat controlled play. That's why it's on the board. Uranium. All right, we got Bill Gates, China, all talking about nuclear power. Realistically, we have to build a lot of nuclear power plants if climate change is legitimately a problem. So at this point, I think we need to get into that play. We were in, we were out, we missed some of this big leap. It's way below valuations it's had in the past. So I've been waiting to do a big trade alert across the board, and we will get back into uranium, URA. FNGU taking a little bit of a dive because of Tesla, Alibaba, and Baidu. It has 12 huge tech giants, 2 from China, 10 from the US, has outperformed the QQQ by 200% since conception. And that's how we get that bit of a hybrid in that Bootcamp core. Rare earth metals, REMX is a beautiful play. Really bullish on that for the next several decades outside of rate hikes. I love being in rare earth metals. That's lithium and cobalt primarily. I think we need to increase the volume of lithium by 40 times in the near future based on just the growth trajectory of electric vehicles. So just huge play there. That protects your Apples and your Teslas from compressed profit margins due to the commodities they use and metals going up in cost. Okay, copper, we need a lot more copper for all of this as well. COPEX, another play. And then TAN is the solar play. So these are all really looking way into the future. We're looking at progressive policies, globalist agendas that are getting pushed really aggressively right now. And that's really the theme for the Bootcamp core. That and a big Bitcoin position. All right, dollar index. I am amazed by the gains we picked up in October when the dollar fell from 94.50 to 93.34. Okay, so just incredible, the profits we made. Now, we're still seeing oil and crypto go up in the face of the dollar recovering much of that sell-off it had in October. Okay, so let's look at what happens when we pass budgets. Okay, last time we passed a budget, we get the dollar to fall from 94 to a low of 89. Okay, so what do you think's about to happen when we pass the Build Back Better budget? We've got a record trade deficit. I think we're going to see this fall to 90. So if you're looking for a short-term top in cryptocurrencies and oil, look for the Build Back Better to pass and then watch DXY head towards 90 and then we're going to prepare for a correction after that. Okay, so that's what I think is the single best way to predict top in NRGU, Bitcoin, and Ethereum. Now, what's going to happen if we can't pass the budget and we suddenly can't issue any more treasuries? Well, then the dollar could break up. Now, how high can the dollar go? Well, here's a good look in March of the kind of moves we can get in DXY. So if we want a safe place to park cash in the short term, probably the dollar's our best bet, because on the downside, we're not going to get eaten alive. And we can react quickly as soon as the budget's passed. On the upside, we can see it can make a significant move. Now let me add in EUO so we can compare the returns. So pretty close to the rate of change. So let's look at this. So we could have made, what is that, 10% gain from that move right there. On EUO, excuse me, more like a 15% return. So this will be the safest place to park cash if we're worried about volatility coming up. So where are we at now? Here's what it's looking like right now. So I'm gonna go ahead and remove the percent change. Let's reload that. Okay, so if we go along the dollar and lock in some gains we've had, and we're wrong, and the deal passes, we're looking at quickly getting out and not getting killed. Okay, maybe we lose 3 to 5% max the day that the deal passes. But if we were to go long treasuries, let me just switch out this to the TLT. Now, on the other hand, if we would go to long treasuries and we're wrong, this could really just fall off a cliff. So the potential loss is in more like the 20 to 30% range. So, and remember, TLT is 1/3 of TMF, which is the product I would put us into. So if you're looking for a really safe place to park cash and make a gain if there's a crisis, EUO. If you want a medium risk asset, it's the TMF. Punch that in. Okay, so you can see there it is. There's that 40% move on TMF. Well, the second they pass that Build Back Better budget, I expect this to go right back down to where it was just at the start of October. So very not happy to see this move, because as you know, that's one of the plays I wanted to put us into in case these characters can't pass their budget. So that definitely makes me nervous. And then the other play is UVXY. This is the ultimate hedge, but by far the riskiest. So I've been very reluctant to put us into any of these until we get better clarity. Because when we look at it, treasuries are a bad bet, way overbought. Biggest bubble on earth is US Treasury market. Interest rates are extremely low compared to, so on a 30-year note, you get 1.8%, but the inflation rate at the very minimum is 4%. So it's a suicidal investment unless you're a bank and you just want to pay deposits on interest. Otherwise, it's a huge speculation. The dollar, again, is at a critical level. I don't think you'll get killed going to the EUO position. But again, most likely outcome is this is about to fall. And then UVXY, again, if they pass this budget, it's probably going significantly lower. So we're really trapped. That's why I remain stubbornly in our positions until we see the outcome of these budgets. All right, now a lot of talk about the real estate sector crashing in China. A lot of people looking at the Chinese credit impulse, on and on and on, all this negative talk about China. Well, here's their currency strengthening incredibly since March of 2020. Okay, so their economy is strengthening. Now it's slowed down, sure, okay, but it's not crashing. So we really have no reason to think China is in significant trouble. MCHI is a good specific ticker. So here's the look at MCHI, definitely below this level here. But again, I think it's stabilizing, and I think you're going to have better returns in China for the coming decade. Okay, so let's put this back to the. So, okay, no problems in that. All right, here's a look at your NRGU, just showing you the massive return. Now, a lot of people like to look again at Fibonacci levels, Bollinger Bands, RSI, all that, moving averages, crossing over of moving averages, fine, or valuations. Just don't do it with the leverage product because it can be misleading. So if we look at NRGU, it looks, like getting ready to fall off a cliff here and at a new high. But if we look at what it's actually playing, which is the top 10 US oil companies times 3, well, we can see that Exxon is way below its peak valuation. The expectation for demand for oil is going to grow to record levels next year. The price of oil is anticipated to hit 90 by the end of the year and 120 by next summer. Some people like to joke about $200 oil. I promise you that won't happen. The whole system will collapse way before that even gets close. But I'm not going to get bearish on NRGU unless I think we're going to lock down the globe and do a debt ceiling crisis until Exxon is back towards some of its best valuations and profit margins in its history. So it's nowhere near that level. Okay, if I go to a percent change, it's still trading 60% below its all-time high, or excuse me, 40% below. So it's just got a massive move higher. Just has a potential for a massive move higher. So from 35 up to here, yep, about a 40% drawdown from its height. And I think it's going to break into new highs. All right, here's oil against bonds. Just bizarre. These two typically are highly, highly correlated. Let's zoom out a little bit. So look, oil, I was investing in China after the Trump trade deal with China, which I thought was BS, made no sense. Why would China agree to essentially give it no chance of becoming the economic leader? And of course, they had no plans to do the trade deal. That was all BS. And we were investing in China saying, okay, they said they're going to do this deal. Meanwhile, China collapses, oil collapses, and mysteriously a sickness spreads around the globe. Okay, so but you can see these rates are highly tied to the price of oil. And what are we seeing now? Okay, so you can see this extreme correlation. We had oil go up, bonds tried to ignore it here. And remember, the Fed is buying bonds, so it's trying to suppress those yields. And you get this huge jump in the yields, caught up with the price of oil. They tracked each other very well all the way through this period. And now they're starting to really fight here. So we're getting that jaws opening up. So now we've got price of oil continuing to push higher and higher. And then we have these bond yields going lower and lower. So who's correct? Now, I believe most of this move is due to short squeeze. Massive amount of people betting down on bonds. And then the labor force participation rate didn't even budge a bit higher Friday. And so the bond market took those short sellers to the cleaners, and that's a short squeeze. Oil is not buying into this at all. So I'll tell you what I expect. Either oil tanks, we don't pass the budget, and maybe even go to a lockdown this winter, and the yields end up being right, or we pass the budget, we don't lock down, and these interest rates go skyrocketing up, and oil heads towards 90 to 120. I think the probability is much, much more likely that the yields go higher and the price of oil goes higher, that the Democrats do pass a budget. Their polling is falling. If they go lock down the country and create a debt crisis, start to defund the government shutdowns, I just don't see it. It'd be suicide. And so that Virginia election was so important to reduce our risk of this event happening. Okay, let's look at some more commodities. Copper futures. So again, we use copper when we're building stuff. That's the reflation play. That's where all the money's been flowing. We've been seeing gold and silver not get a bid. We've also seen Bitcoin and crypto trading as more of a inflation hedge, more similar to the correlation of oil compared to gold and silver, more of the stagflation, so the opposite. And we'll look at that gold to copper ratio in a minute. But bottom line is I expect copper to go significantly higher. I think China's getting ready to increase its credit impulse and recover its economy. They were taking advantage of a lot of strength due to record imports and exports from the pandemic, from the lockdowns. All right, lumber futures, natural gas, were some outrageous moves. Let's zoom out a little bit. So again, we're seeing this inflation hit certain sectors in little pockets one by one. So we had that lumber just go parabolic and then get crushed. Now it's building back up, still at way above levels historically. So let me hide the natural gas. So yeah, that's too bad this doesn't go back. Oh, there we go. So lumber futures historically have been below 450. It's now stabilized well above 600. Okay, so way, way, way above trend. It went outrageous up to 1800. Okay, and this has been highly correlated to Zillow of all things, the housing stock, which makes sense. Let's look at natural gas now. So we can see the natural gas spike came in as temperatures began dropping. And so just different, where's the current demand? That's where we're seeing these market participants go just ramp up and hijack the prices of these products. Now, a big sell-off in natural gas today, but get ready for winter. This is supposed to be one of the coldest winters in history coming in. And this is what's helping drive that oil price up even during a normal weak period, which is the next 2 months for oil. So not believing we're about to have a crash in commodities currently. This is interesting. The Baltic Dry Index, cost of shipping commodities, has dropped massively, still way below, way above trend though. So the trend for history has been in the 1700 level, still 2 times above that. But again, showing a little bit of slowdown in demand and congestion, which again, I would say is in general healthy. Okay, so here's where we're seeing the flattening of the yield curve. We got in the blue line, the 2-year spiking up from February to here, 350% while we have the long end staying flat. So expecting rate hikes, policy mistake coming in due to too much inflation. Now, long term, if we zoom out, we need to realize the only way the government can expand its deficit over a long period of time is to drive those rates lower. Otherwise, everybody's losing a fortune. And so that's just not going to happen. I believe that we should aggressively buy bonds when we break the recent high of 2.4 on the 30-year. And that there's a very short window that these could go lower based on a debt ceiling crisis. And I'm afraid we may have missed the majority of this move due to that short squeeze. So I'm not very fond to add treasuries unless I'm very high conviction that Joe Manchin is not going to pass the Build Back Better bill, and that that Mitch McConnell is not going to extend the debt ceiling. Now remember, that's what gave us this relief rally from September. Was McConnell said, you know what, guys, here's a $500 billion and an extra few months for you to get your budget together. So we'll see how that plays out. But yeah, the big play is that the rates are likely headed to zero, and then we're going to have some serious problems to face up to. But this next cycle is not done yet. So I believe we're going to go higher in rates until it creates problems, and that likely this will peak out around 2023, and it will stop rising once they start to aggressively hike rates after midterms and create a crash. So we want to start buying up those bonds as they're selling off. So remember, bonds go up in value if the rates go lower. So we want to buy the bonds as they're losing value as the rates go higher, expecting that the economy will collapse if those interest rates go too high. The absolute highest interest rate I anticipate the 30-year hitting is 3. And I think we could safely say 2.8 is more realistic. So your buying window is 2.4 to 2.8. Buy them up. Don't worry about drawdown, and then sit back on those bonds. It's going to be a little while before we get to that level. Okay, gold copper ratio is a great way to predict rates. The main period I want to focus on is 2002 to 2006. So that's how ugly it could get for commodities like gold and copper, like copper and oil compared to gold. So again, if we really recover jobs, that's what's going to drive this up. Now, if we're getting less than 500,000 jobs, then I expect the opposite. Watch for that gold and silver to finally take off. So we'll see just how smooth this labor recovery is, and how much can the Build Back Better plan really help. The free childcare might actually really be beneficial to labor growth. We'll see. We'll just see. Okay, here's the bond markets I track: TLT, JNK, LQD. Look at this massive move in the TLT. I think this is mostly a short squeeze, and wouldn't make too much of it. So we started to taper. You could argue that the tapering is going to cause a stock crash, low growth, and TLT is just going to melt up from here. On the other hand, if we pass the Build Back Better budget, there's going to be a lot of bonds issued, and inflation expectations come ripping right back in. So I'm not very happy about buying the TLT right now because of this big move up and it being way below inflation. Probably would rather do a dollar UVXY combo and less treasuries based on missing this big move in the TLT if we're going to get worried. So we'll talk about that later. All right, this is where we watch the debt issuance, the treasury auctions. Janet Yellen needs to get the treasury coffin to probably $700 billion. It's been floating around like 70 billion. So the US government's out of money. And Jim Bianco had an interesting thing predicting that the current amount of money that we can raise, thanks to McConnell, will get us through January, February, rather than December 3rd. So I'm going to start analyzing that more. But bottom line is the government's going to stop being able to borrow money soon. That's going to be very problematic for stocks. But I'm not going to be worried about rates rising until that reverse repo falls. So bring it on. Let's load it up with some debt. That's good for stocks and how we're playing the markets currently. All right, so here's the data that a lot of people said was good at 531,000 jobs. I think to get rates rising and to spark the growth to value rotation, we need to start averaging over 700,000 jobs and not 500,000. I think 500,000 is enough to keep everything tame and actually obviously benefit the NASDAQ over the tech sector and to keep yields low. It's really, we got to get towards 700 to 1 million jobs per month. So we'll see. We've had, in the last year, we've had 3 prints out of 12 that were above 700,000. So not a very good batting average. And I'm afraid with what I'm anticipating for the hospitals for December, January, I don't think you're going to get a good print in those months, maybe November. And then we have the OSHA rulings coming into effect January. So we may not see strong labor recovery till February, March, April at the earliest, probably more like March, April. So we may see a melt up all the way to March in NASDAQ and energy, and then start to see that rotation into April, and then perhaps shit hits the fan as the fiscal cliff becomes problematic. Okay, so we get this print tomorrow morning. I'm gonna bet it goes up. Now, bond yields are not saying that. Bond yields are saying this is gonna go lower. I highly, highly doubt it. This print, we should see the energy starting to affect the CPI. And then we should see wages and rent. And unfortunately, those are going to be sticky and not go away anytime soon. So I think we're going to see a hard time for the core inflation rate to go below 4 for the next year. And it's going to pressure the Fed to start hiking rates. So we'll see how that plays out tomorrow. Meanwhile, the credit's increasing in banks. That's bullish for how we're positioned. And boom, consumer credit, big jump, $30 billion. So consumer remains strong. Banks are flush in cash. Interest rates are ridiculously low. Where are you going to put your money? Here's the retail sales jump. So strong retail consumer. It's a new all-time high in spending. All right, the jobs data, nothing else really. This is a new print today. Producer prices remain at extreme highs, again, 8.6. We're starting to see things like Amazon and they're losing their profit margins. Okay, so all the people selling goods and services are losing their profit margins. That's going to become problematic. Jobless claims can't get below 200,000. So people are quitting their jobs, finding better paying jobs. And probably the most important one's this one. So, all right, all the hate on Trump. What do? You got labor force to go from 62.5 to 63.4. And that's after 2 decades of labor force either trading flat or collapsing. As we told the American people, it's a great idea to give up all our manufacturing to China. We go to so here's what the bond market's saying. All right, so we got all these headlines, 4.5% unemployment rate, blah, blah, blah. Why is the bond market not crashing if it's such great employment? Well, it's because of this. Okay, so we need jobs to grow and we need the percentage of Americans to rise. The trend is that this could be, it was rising at about 0.7. Okay, so if this had continued, we'd be at 64% labor force participation rate right now. If we didn't lock down the country and unleash carnage on the world, which I believe was done on purpose. Okay, so that's what the bond market's not going to like. They want to see the the labor force participation rate moving up. Until that happens, jobs growth is probably going to really slow down here. So what's happened? A bunch of the people over 55 have said, screw this, I'm retiring. I've made a ton of money in my retirement account. It's too dangerous to go back to work. I don't want to deal with all the BS. I'm done. And so this is going to make wages rise. This can make the companies fight over labor and compress those profit margins. So that's why bonds are saying this is not a good recipe for stocks if this doesn't, if the labor markets are tight and wages are going to have to go up significantly. All right, balance of trade just collapsed, minus $80 billion. Okay, so if you run up your deficit and your balance of trade negative, we call it the twin deficits, dollar goes down. That's how we're positioned. All right, some canaries in the coal mine. We don't want to see Apple, most valuable company in the world, selling off. No fear there. Tesla, if it were selling off normally or because of rates rising, I'd be much more concerned. But we have Elon Musk telling everybody to sell it. So just absolute comical guy. He is a character. As far as, let's look at some. So there we go. There's that Fibonacci level right at 1,000. I had just eyeballed it, but there you go. Next big level below, I believe will be the 800. Okay, if you break, the real line is about 778. So one warning sign at 1,000. If it dumps below that, I would expect it to stabilize at 800. And if it goes below that, this could be big problems for indexes and systemic selling. My guess is this is a good buy the dip opportunity. The rates are too low on interest rates. The reverse repos at 1.3 trillion. So we don't see the interest rates rising to really pressure this lower. And you're probably going to have a whole mania of people buying call options. So ARK funds. This is a product that is leveraged to the brim in long duration assets. Something I watch for problems, nothing to really get excited about there. Out over in Asia for EEM, I'm watching Tencent Holdings. If Facebook doesn't own it, Tencent does as far as phone apps go. So looking good. Alibaba, the Amazon in China, stopped its massive crash. So we like those two plays if you're patient. Samsung stabilizing here. This is more of our EFO play for pro, and then Toyota staying in there. So the only real warning signs we have that I think are worth watching is Tesla, but we know why Tesla's selling off, because Elon just scared the shit out of everyone, saying he's going to sell 10% of his portfolio. So I see no reason to freak out at this moment in time with our current strategy. Okay, PMIs in China are above 50, and Europe, they've been falling, but okay, here's a new print. So we actually have a slowdown in imports for the first time, but still at record levels. So let's zoom out. So we are seeing a slowdown in Chinese imports. All right, that's the first bearish print we've seen in months. but still at very, very high levels. Let's go out to max. So again, the trend line before the pandemic was in the 1750 range, and we're still at 2156 at a high of 2389. So just still massive amounts of imports, and we know what's been happening. They've been crushing all kinds of assets, call it smash and grab. I anticipate they're about to increase the credit impulse. And again, this is likely to jump once the US impulse is reignited with the Build Back Better plan. But that is definitely new data that's just come in, and we're seeing a little slowdown in exports. But again, grand scheme of things, still the trend line was at 22, and it's still above 3,000. But yeah, we definitely first time in almost a year where we're seeing a slowdown in imports, exports. So we're going to pay more attention to that now moving forward. Okay, what about balance sheets? We've still got $500 billion of suppressing yields coming in on the US. And the stock market's been extremely correlated to the growth of the balance sheet, although I'd argue it's really the growth of the deficit, and that this is enabling the deficit to grow. And then in Europe, big print. So they're not slowing down in the two main central banks. Japan grew there slightly, but it's been pretty flat. Okay, let's hop into some news headlines. David Hunter thinks we're about to have a big melt up in gold and silver. Interesting. A new data saying the sickness is likely to spread whether you've had the medicine or not. CBO is expecting to piece by piece give cost estimates in terms of the deficit as it comes out, so we get a better idea of what this impact will be on the budget as it's coming out. Very important for Joe Manchin to approve it. Peter Schiff saying the inflation's just getting started. China bragging about their shelves being stocked while a lot of US are not. Here's the cold storm coming in, and then natural gas is down, so just get ready. Probably gonna see those prices go up. Goldman Sachs buying up property debt after it's crashed massively. It's a risky bet, but I largely agree. Beijing must ease up on the property sector, boost infrastructure spending sharply, or accept much lower growth. The only likely way out of this trap via a substantial rebalancing of income. It'll take many years at best. So a lot of people think China's getting ready to print as US slows down. These central banks like to take turns. Chai Girl says, I think we continue to see strength in energy and materials. This infrastructure bill gave an extra boost today, but more importantly, longer term. In order to make this green transition, ironically, we're going to need a crap ton of fossil fuels and metals. All the big banks were nowhere near predicting this melt up this year. We now have Goldman Sachs saying they think S&P hits 5,000. I think Morgan Stanley's predicting 8,000 Ethereum. Elon Musk talking about what types of metals we need for the long or medium range vehicles. Here's the futures contracts for Ethereum. You can see pointing much higher into the future. JP Morgan, is Ethereum overbought? There's little doubt that momentum traders have amplified the recent rise in Ethereum prices, but we find no evidence on our metrics as yet that momentum signals are in overbought territory. Melt up continues. There's a big worker strike this week. If Bill Gates had not sold his Microsoft shares, he would be at 700 billion. This is pointing out when the VIX has gone up with stocks. So sometimes it's predicted to crash, not always. There's talk about the US releasing some of its oil and why that'd be a bad idea and have very limited impact on the oil price. $1 trillion in authorized buybacks, record high. You don't want to get on the wrong side of that trade, so that's why we've been so reluctant to hedge. Goldman says the inflation overshoot will likely get worse before it gets better. The banks have been underestimating the inflation. This shows this rising every print. Started off at 2, then went to 3, then 4, and then 5, and now they're predicting 6. So, yeah, we print $12 trillion globally, and then reduce the ability to create goods and services. And what do you know? Reduction of goods and services and an increase in money, and prices go up. Crypto hit 3 trillion market cap. Again, the trend is Bitcoin goes up first, outperforms, Ethereum catches up, then altcoins next. We've got Bitcoin dominating right now, Ethereum keeping up. I believe we're about to see altcoins just march higher, especially because they are more efficient. Here's a look at some of these other coins. Cardano's at a good discount right now. Probably the one I'll be buying up today for Rebel. Okay, here's Jayapal. The Build Back Better Act is a transformational agenda that delivers on the promises we made to working people across this country. Congress must swiftly pass this bill and send it to the POTUS so we can begin making these necessary investments in our communities. And yeah, they need to combine it with the reconciliation so they can increase the debt ceiling. And then it might be pretty hard to pass much after that, is what it's looking like. So things will get much hairy by Q2 of 2022 without a lot of jobs coming online. All right, guys, so that is that. We're going to switch to the trading strategies now. Quick little ad before I end the recording for the freebies watching this. This is where the video ends. If you're not a paid member, you're going to miss out on the exact formulas for how to invest your money. So call Dean at 505-322-7515.